If you've ever owed money at tax time and wondered why the IRS tacked on extra penalties, you're not alone. Here's the thing most business owners don't realize until it's too late. The IRS expects you to pay taxes throughout the year, not just in April. Miss that expectation and you're looking at a 7% penalty that compounds every single quarter you're short. But there's a way to completely sidestep those penalties even if you end up owing a big balance when you file. It's called Safe Harbor, and once you understand how it works, you'll never pay an underpayment penalty again. I'm going to walk you through exactly how Safe Harbor protects you, what changes if you're a high earner, and how to handle curveballs like RSUs or big bonuses. But before we get into it, please like this video and subscribe. It means a lot to our channel, and we're sharing videos on a weekly basis to help you set yourself up for a better financial future. All right, let's dive in. Safe Harbor gives you two ways to avoid penalties. Option 1, pay at least 90% of what you owe this year, or option 2, pay 100% of what you owed last year. Now, if your adjusted gross income was more than $150,000 last year, you must pay at least 90% of current year or 110% of last year. Hit either number and you're protected. No penalties, period. Now, here's what trips people up. Safe Harbor doesn't mean you won't owe money in April. It just means you won't pay penalties on top of what you owe. Let's say you paid $50,000 in estimated taxes throughout the year, but your actual bill comes in at $120,000. You still owe that $70,000 difference. But if your $50,000 in payments met Safe Harbor, you pay zero penalties on that balance. The IRS cares that you made a good faith effort to pay as you went. Safe Harbor is your proof of that effort. For 2026, your quarterly deadlines are April 15th, June 15th, September 15th, and January 15th of 2027. And here's another detail that catches people off guard. Only Q2 covers April and May, 2 months. So if your income is lumpy, those deadlines don't line up evenly with your cash flow. Keep that in mind as we talk about strategies later. If you made over $150,000 last year, the IRS has a different rule for you. Instead of paying 100% of last year's tax to hit Safe Harbor, you need to pay 110%. That extra 10% catches a lot of business owners off guard. Here's the key detail. It's based on your prior year adjusted gross income, not what you're making this year. So if you had a great 2025 and cross that $150,000 threshold, your estimated payments need to hit 110% of last year's bill if your business is growing. The good news? If your business is growing, this can actually work in your favor. Let's say you owed $40,000 in tax last year on $160,000 of income. This year, you're projecting $300,000 and a tax bill of around $100,000. Your Safe Harbor number is $44,000. That's 110% of last year's tax bill. Pay that across 4 quarters, roughly $11,000 each, and you're protected. You still owe the difference in April, but with zero penalties attached. That's the power of the 110% rule when your income is climbing. You can bank that extra cash, earn income on it, and pay only in April. Now let me share where I see high earners make mistakes. The biggest one is using the wrong year to determine which rule applies. You look at last year's AGI, not this year's projection. If your 2025 adjusted gross income was $140,000, you use the 100% rule for 2026. If it was $160,000, you use the 110% rule. Simple as that. The second mistake is assuming Safe Harbor means you're all paid up. I've seen business owners get blindsided by 5- and 6-figure April balances because they thought Safe Harbor covered everything. It doesn't. It covers penalties. Your actual tax bill is still your responsibility. The third mistake is backloading payments. The IRS calculates penalties separately for each quarter. If you skip Q1, Q2, and Q3 and try to catch up to Q4, well, you still owe penalties for those early quarters. You can't go back and fix it with estimated payments. But here's something that can help, and I'll explain in a minute. W-2 withholding gets special treatment that estimated payments don't. Before we get into that, if you receive RSUs as part of your compensation, there's a tax gap you need to know about. When your shares vest, your company withholds 22% for federal taxes. That's the standard supplemental wage rate. But here's the problem. If you're in the 32 or 35% tax bracket, that 22% doesn't come close to covering your actual tax liability. You could be looking at a 10 to 15% point gap on every vest. On $100,000 worth of RSUs, that's $10,000 to $15,000 in under-tax income. Now, multiply that by vesting events throughout the year. The gap adds up fast. And if you're not making estimated payments to cover that difference, you're headed straight for underpayment penalties. 3 ways to handle this. 1, increase the withholding on your regular W-2 paycheck to compensate. 2, make an additional payment in the quarter your RSUs vest. 3, ask your employer if they allow voluntary additional withholding on equity compensation. Don't let the default 22% rate catch you off guard. Now, if your income arrives unevenly throughout the year, there's a strategy built right into the tax code for you. It's called the annualized income installment method. Instead of assuming your income is spread evenly across all 4 quarters, this method lets you base payments on what you actually earned in each period. This can be huge for seasonal businesses, entrepreneurs with big Q4 revenue, or anyone with concentrated income events like bonuses or stock vesting. Here's how it works at a high level. You calculate your actual income through each quarter, you multiply it by an annualized factor to project full year income. Then you figure out the tax on that projection. The IRS has specific multipliers for each period. For Q1, you multiply by 4. For Q2, you multiply by 2.4, and so on. If you use this method, you document it on Form 2210, Schedule A1 when you file, or you just give it to your accountant and they'll handle it for you. This shows the IRS that your payments match your income timing. You can completely eliminate penalties that would otherwise apply if you just follow the standard calculation. For business owners with lumpy income, this can be one of the most underused tools in tax planning. Here's something that most people don't know about W-2 withholding. The IRS treats it as if it was paid evenly throughout the year, even if it wasn't. This is completely different from estimated payments, which only count in the quarter you make them. So what does this mean for you? Let's say you're behind on estimated payments heading into December. Q1, Q2, Q3, you're all short. If you dramatically increase your withholding on your remaining paychecks or on a year-end bonus, the IRS treats that extra withholding as if it happened equally across all 4 quarters. It retroactively fixes your earlier shortfalls. Estimated payments can't do that. If you have W-2 income alongside your business income, this is a powerful year-end move. Behind on quarterly payments? Max out your withholding in November and December. The IRS won't penalize you for the earlier quarters because that withholding spreads backward automatically. It's one of the few legitimate ways to fix past quarter underpayments. Quick note on state tax because the rules aren't always the same. Most states follow federal Safe Harbor framework, but there are some big exceptions. California has what I call the $1 million rule. If your California AGI hits 1 million, you lose access to the prior year Safe Harbor completely. You must pay 90% of your current year tax. No option to use last year's number. California also uses different quarterly percentages. Now, Maryland requires 110% of prior year tax for everyone, regardless of income level. And New York triggers estimated payment requirements at just $300 of expected tax, way below the federal $1,000 threshold. If you live in a high tax state, don't assume the federal rules apply across the board. So let's bring this together. Safe Harbor can be your shield against underpayment penalties. For most business owners, paying 100% of last year's tax across 4 quarterly payments keeps you protected. If you made over $150,000 last year, that number bumps to 110%. For variable income, the annualized method lets you match payments to actual earnings. And if you have W-2 income, strategic withholding adjustments can fix quarterly shortfalls in ways estimated payments simply can't. The key is knowing which tools apply to your situation. If you want help building a tax strategy that actually fits your business, that's what we do at ProSeer. We're a concierge accounting and tax advisory firm built for modern entrepreneurs. We love the opportunity to meet you, and the link is in the description if you want to talk. Thanks for watching, and I'll see you in the next one.